Thank you, Peter. Today I'm just going to talk to you about comparing and contrasting financial reporting to sustainability reporting. So when we think about research questions in financial reporting, these are the types of questions we ask. So who will use the information? What's the objective? What's the goal of the measurement? How should we record that information? What kind of measurement system should we use? The usefulness of the information, so what decisions are going to be made with the information. And then disclosure is, well, how should we report the information? Timeliness has to do with how quickly we provide the information to the users. Manipulation is something that occurs after we've started measuring things. What kind of incentives does this create? And how can we deal with those kind of issues? And then reliability. Can you trust the information? So when we think about traditional financial reporting, the who question is investors. You know, we want the information for investors. The objective is to maximize profits. The measurement system is in monetary units, such as dollars. The usefulness of the information, when we think about that, is to do with making investment decisions. Disclosure of the information is in the financial statements. And when we think about timeliness, the rules for timeliness now are quarterly. So we have quarterly earnings announcements, quarterly financial reports, and then the bigger annual report. As far as manipulation is concerned, we tend to think of what are the incentives to boost earnings. Beyond that, are they trying to, could management be trying to manipulate the numbers to meet analyst forecasts? Are they trying to window dress the financial statements? And in the extreme, could financial fraud be occurring? And then in terms of reliability, we have certified public accountants auditing the financial statements. And so there's a huge amount of research looking at audit quality. Turning to thinking about sustainability reporting and the research questions, we have the same basic framework going on. You know, who's going to use the information? What's the objective? How are we going to measure things? How will this information be useful? What mechanism should we use to disclose the information? Timeliness, manipulation, and reliability. So turning to sustainability reporting, you can think of the objective being we want to have a corporate strategy for good, right? So the idea is a company doesn't want to be affecting the environment or hurting society. Turning to the measurement, a lot of things are measured in non-monetary units, such as, you know, carbon emissions or diversity, things like that. The usefulness of the information now, instead of it being for investors, it's for stakeholders such as customers and employees. Then when we turn to the disclosure of sustainability information, we see that there's many different ways that the information is disclosed. So we have sustainability reports that companies produce, many companies, especially larger companies, produce. Then there's information in the proxy statement that can tell you about the governance of the company and how executives are rewarded. Then we have the company itself providing information on the website. Then if you want to do more searching, you can find various disclosures on the EPA's website, EPA filings. Then we've got watchdog organizations checking on the firm and reporting on what they're doing. The SEC also provides various requirements for disclosure. So there's many different sources of information that you can use to try and find out what the firm's doing on the sustainability front. Then the timeliness depends on the information. Sustainability reports tend to be produced once a year. And then when we look at manipulation now, we've got this issue of greenwashing. You know, is the firm telling you stuff that looks good, where they look good, and not disclosing information about when they're not doing good things? There's also whitewashing, you know, acting like they care about society. Turning to reliability, the rules are evolving, so there's not much clear standards right now on how a firm should report the numbers. So there's a lot of flexibility there, and this in turn makes it more difficult for people to rely on the information. And also because it's in non-monetary units, it's harder to quantify this information. And then when we turn to assurance, there's limited rules on how to audit this information that's still evolving. And there's also multiple providers. So not only do public accountants audit this information, but we also have engineers looking at the various CO2 emissions, and then lawyers looking at the society metrics, such as diversity or inclusivity and so forth. So you can see it's quite a different framework. And then just turning to think about how this plays out for a real firm. Suppose we have a beverage company and it produces water for customers. Then you can think of from a financial reporting perspective, what we'd be interested in knowing is, what are the cost of the materials? How much do we have to pay labor to produce the materials? What's the factory overhead? How much are we going to report as cost of goods sold? And how much revenue have we generated from the sale of this particular product? Then we produce the income statement that tells us revenues minus cost of goods sold, giving us a profit number. And we also have the balance sheet where we report the equipment and the inventory, and so forth. Turning now to sustainability reporting, the focus now is on the environment and the planet. So, and also society. So the questions that we ask this beverage company are quite different. So, for example, does the water in the supply chain that they're using for their product impact biodiversity? Is there any child labor in the supply chain? Do employees have good work conditions? And then turning to the factory, how much carbon and greenhouse gases are emitted in the production of this product? And then looking at the product itself, we might ask, is the product recyclable? And then also, is the product healthy for humans, right? So you can see that the questions being asked are quite different from financial reporting, which is all in monetary units. Then at the end of the day, we might find a sustainability report where the company gives you information on the environment and society. So just comparing the different perspectives, you can see that the users are different, investors versus stakeholders. The objective is different, measurement is different, and basically all the different aspects are different for each measure. So in conclusion, accounting has the capacity to embrace the measurement and disclosure issues involved in sustainability reporting. People care about what is measured. Better measurement systems create opportunities for better decision making and improve monitoring and increase trust. So that's my talk. So thank you very much. And if you want more information on accounting and measurement in the carbon world, then I suggest you look at eLiability Institute. And then also Richard Sloan and I have a class that we're teaching on sustainability reporting where we discuss these issues. So thank you.